Hello everyone and welcome to today's session. My name is Philip Nathan of Nathan Trust. I head up the client services team here. I would like to introduce our speaker, David Bruton. David is a certified tax advisor and a chartered accountant. He has considerable experience in helping companies and individuals with international tax planning. David heads up our accounting and tax team. A recorded version of this webinar will be available on the website, and we will send a link to everyone who signed up after the webinar. We'd love to hear from you, so please send in your questions and queries throughout the session. So welcome, David. Thank you for taking the time. We had a number of questions beforehand, so we might as well jump into those. The first one was, I'm living in Ireland since March, and am I liable to pay tax here?
I suppose the answer is you probably are, in that I suppose we're into the start of December now. So if you take someone who's been here since mid-March or early March, they're over the 183-day test to decide if they're tax resident in Ireland. So I suppose that's the first hurdle. Are you tax resident here? You'd also just need to consider whether you might be considered tax resident in another jurisdiction under a double tax agreement, and if Ireland has a tax agreement with that country, and you then need to look at the tiebreakers between the two countries that's contained in the double tax agreement. But I suppose the short answer is it's probably likely that you would be tax resident in Ireland in 2020 if you're here since early March.
Okay, and is there any scenario where you might be here since early March but you're not tax resident?
I suppose if you'd been in and out of the country and you hadn't hit the 183-day mark, I suppose it's not so relevant for anyone who's maybe arrived in early March, but what you would have in the past, I suppose in a normal years, you may have had people who are on assignment here. So where, let's say if you're working for a US multinational and they asked you to go and do some project work in Ireland and that was going to take up to maybe 6 months, you would normally be covered under that. I suppose you wouldn't be hitting the 183-day threshold generally there, but also the income, even though you're working in Ireland, it wouldn't necessarily be considered taxable in Ireland.
Okay, and what I hear is there's a bit of the revenue where they talk about is force majeure and how it's tested, and is there a case-by-case nature in this, and how are revenue likely to apply it? That keeps coming up from both revenue and other websites, and questions from clients of ours as well.
Yeah, so I suppose this was something that revenue flagged in March when people weren't maybe able to travel to where they would normally go to if they were leaving the country. And what it basically says is that if you're prevented from leaving the country, and you wouldn't have been in the country on the following day, but for the fact that you were prevented, revenue won't consider you tax resident here during that period. Now, I suppose historically, the classic example given was that you're in the airport, you're getting ready to board your plane, and there's a technical issue with the plane and you can't fly, and it's not feasible for you to make alternative arrangements. In that scenario, revenue wouldn't consider you tax resident wouldn't consider you being in the country on the following day because you hadn't intended to be and you were prevented by force majeure. Now, I suppose in terms of the COVID situation, revenue's guidance was pretty sparse at the time. It just said that depending on the circumstances, force majeure provisions may or may not apply. What we found, I suppose, in dealing with revenue on behalf of clients in relation to this is that the interpretation is pretty narrow. So I suppose what they're saying is, were you prevented from leaving the country? Not, did you decide not to leave the country because of practical issues that maybe made it more attractive to stay here for part of 2020? It was really, were you prevented? Was there a ban on you flying to whatever country you resided in normally or where you intended to travel to, rather than, let's say, other practical considerations?
So they didn't shut the airports down. Like, you could get out of Ireland, you could probably get to most other countries you wanted to get to.
Yeah, I mean, we had a client, for example, who had intended on traveling to another jurisdiction but decided to stay here because it would have been maybe a more volatile place to be during COVID-19, that, for example, wouldn't have been considered sufficient grounds for it to be force majeure type scenario. And as well as that, the fact that that country may have stopped incoming flights, it didn't stop him maybe getting to that country by a slightly roundabout means. And that seemed to be the first position that we found revenue took in that scenario.
Okay, I'm getting a couple of questions in there. We'll come to them towards the end of the webinar, but that's okay. And just on people who joined late, there's a recording of this, and we'll send a link to everybody that's on it if you missed the start of it. I guess, and following on from that, so people weren't prevented leaving. I guess there's two parts to it. There's one is, and we're seeing a lot of this as well, where people are on PAYE in, say, the UK or the US, and they're PAYE, so they pay all their taxes in the UK, and their general feeling as a taxpayer is that everything's taken care of. Now, due to COVID-19 travel restrictions, they're in Ireland, and they're living in Ireland for more than 183 days. Mm. Are they right in saying that because they're PAYE, someone else is responsible for their tax? It's not their issue?
Not necessarily, I suppose. If you take someone, say, who, let's take a scenario where someone normally worked in London for an investment bank or something, and they're Irish and they've come back to Ireland, and they've been working here since March because there's no point traveling back to London, the office is closed. In that scenario, they're here for more than the 183 days, so they're personally tax resident. But as well as that, they're not really here on an assignment that their employer has asked them to go to Ireland to do a project. They're just happen to be living here and working here. So I suppose the employer in the first instance should be operating a payroll for them. The fact in Ireland, that is the fact that one is being operated in the UK doesn't mitigate that. So if you look at the Irish situation, payroll should be operated. The person is taxable on that income here. They're carrying out the work here. They're now probably tax resident here. So it's Irish source income. They're Irish tax resident. It's taxable in Ireland. And the fact that it's being taxed in the UK it doesn't mitigate that. It would probably mean that you could be in a scenario where the person maybe shouldn't be paying any tax in the UK for the last number of months and should have only been paying tax in Ireland. And it may be a case that, again, they're two separate things. I suppose one is you're trying to get your situation correct in Ireland with revenue here. And the second one then is you're maybe trying to talk to HMRC or through your employer to recoup tax that has been paid there that maybe wasn't due.
Okay, and as an employee, that's your responsibility. Like, so you're a person, an employee, you're based in Ireland, you haven't been able to travel back to the UK or wherever it might be. That is your responsibility to fix. You are personally liable to pay the tax to Ireland, the Irish revenue, and to possibly face fines and penalties as well.
Yeah, I suppose in the first instance, it's the employer's responsibility. So the employer should be operating payroll, and that's what revenue's guidance on this would say. And I suppose interestingly, I suppose in preparing for this talk today, I was looking at revenue's guidance, and that was last updated about 6 weeks ago on this topic. So the employer in the first instance has the obligation to operate payroll. But I suppose if you take a scenario where someone's working for an employer that doesn't have an Irish presence, I mean, I think, you know, there's a big number that have been stuck in Ireland maybe who are working for an employer that's based abroad. Their employer, I suppose there's probably scenarios where their employer isn't aware of it. There's maybe scenarios where their line manager is aware of it, but their HR payroll team isn't aware of it. So they're just operating payroll as normal because they haven't been told otherwise. So the employer is responsible in the first instance, but ultimately it's the individual, because if you take an individual who has been here since March and is now tax resident in Ireland, and they're working from wherever they're living in Ireland, they're carrying out the work in Ireland, it is taxable in Ireland.
Okay, and I see that, like, I know that the FT had a story at the weekend saying the CSO in Ireland, the Central Statistics Office, think up to 26,000 people might have moved back to Ireland since March, since COVID-19. So do you think this is something that, like, I guess, how do revenue get aware of the fact that you're in Ireland, and is this something that they will target? What's your experience with revenue with these sort of projects? Is this something they'll be looking to activate an action, and is it similar to anything else that they might have done over the previous years?
I suppose, you know, the way I look at it is if we're aware of this as a potential issue, I'm sure revenue are. To be fair to revenue, they're very sophisticated software systems. They're good at analyzing data, and they have undertaken kind of project work in the past. And how that would have happened is that, for example, in kind of doing standard revenue auditing, they may have become aware of an issue in a particular area of the economy, or to do with a certain type of business, and they would then roll that out. So some of the ones we've seen in the last number of years would have been around medical consultants, and there was a particular thing that they were doing that revenue became aware of and auditing one or two of them, and then rolled it out. So they then kind of did a general trawl of medical consultants, and would have gotten quite a decent return from that exercise. They would have also done something similar with people who were contractors to maybe large multinationals here, but operating through their own personal service company. And again, in carrying out run-of-the-mill audits, revenue probably started seeing that a lot of people were abusing travel and subsistence expenses, and they began to see a pattern. So they rolled it out in the Munster region here first, and then to Ireland more broadly. And again, they would have gotten a very good return there. So how this might play out, I suppose, is I'm not sure exactly how revenue might start identifying people who fall into this category, but once they become aware of it, I think they'd figure out a way to widen the net and come across a lot of these cases.
Okay, and like obviously a clean solution for both the employer and the company is that the company, say they're a UK-based company, set up an Irish payroll. That's reasonably straightforward, isn't it?
It is. I mean, if you take a scenario we're seeing on a reasonably regular basis now is a company that's based abroad, and let's say all the people are in Sweden or Denmark or Finland or somewhere like that, and they've got one person who is Irish and has been working up to now in headquarters, but they've relocated to Ireland because of COVID, maybe family reasons, and they're now saying, you know what, I think I want to continue working from Ireland.
Well, I think in lots of cases the companies are embracing this distributed workforce model and saying it's great, you live in Ireland and you work in Ireland, and that works for everybody. It
is. I think particularly where you've got companies and they've got someone who's key, you know, like a key person within the organization. What we're finding is that I suppose most people figured out you can work remotely, so that most companies are happy to facilitate this. And the simple solution is the employer who's based abroad. They just register with revenue as an employer here, and they operate payroll, and it's very straightforward. It's going to be nothing more onerous than most of them are already doing in their home jurisdiction. And they don't need to set up a legal entity or a company or anything like that here? They don't necessarily. I suppose it depends on the exact circumstances. I suppose if you had a number of people in Ireland, you might want to consider whether you'd be better off setting up a company here, or whether you maybe have a branch here. But in the kind of scenario we're seeing, where it's one person, you know, in a lot of instances, it's just a matter of registering as an employer and operating the payroll, paying over the taxes to revenue, and it's that straightforward in most cases. Okay. A question from someone who's a non-dom, which is non-domiciled, which is a person who is not traditionally not born or reared in Ireland, might be born and reared the UK, France, Germany, wherever, but they're now living in Ireland and they are resident in Ireland. And they said they're non-dom in Ireland and they have foreign income. Is this all taxable in Ireland? I suppose just to maybe elaborate on the non-dom status, if someone isn't familiar with it. This concept of domicile it's where your closest association is with. So I suppose for most people, what happens is when you're born, you acquire the domicile of either your father or your mother, depending on the circumstances. And then once you become an adult, you can acquire a domicile of choice. And for most people, it's not an absolute, but for most people, it tends to equate to where they were born or nationality, but it can differ. So if you take someone who was, let's say, just to pick a very straightforward scenario, someone who's born in the UK to UK parents, and they've lived in the UK predominantly up to now, and they've now moved to Ireland, and they're going to be tax resident in Ireland for 2020 because they're here for more than 183 days. So they're Irish tax resident, but they're not domiciled in Ireland. The scenario for them is that they're taxable on their Irish source income or their foreign income, but only if they bring that foreign income into Ireland. So if they've got passive foreign income, for example, dividends or rent from another jurisdiction from outside of Ireland, and they don't bring that into Ireland, that doesn't come within the Irish tax net in most cases. There's certain exceptions, but they're very limited.
And by bring it in, you mean that they send it to their Irish bank account and they use it to live in Ireland, or buy a car or go on a holiday, or, well, nobody's going on holidays anymore. But.
Yeah, I mean, if the most obvious examples, they send it to a bank account in Ireland and they use it here. Or if they're spending it on a credit card in Ireland, for example, or they buy a property with it in Ireland. I suppose basically if they're getting the use and enjoyment of it in Ireland, that's remitting it into Ireland.
Okay. Okay, and just one here on just back to the UK, the payroll thing. So it's a good one. They're a little bit concerned that if they need to go, if they're in this situation where they're forced to live in Ireland, the travel restrictions, they're going to be they've been in Ireland for all of 2020 or most of it. Now they see they're going to be in Ireland for most of 2021. If they suddenly go on an Irish payroll from the start of the year in 2021, is this only going to bring them up in lights to revenue, and the revenue will say, oh, let's look what happened in 2020? Are they creating a problem? Are they identifying themselves as someone that you could go after, or are revenue more interested in what's happening from now on as opposed to what happened in the past?
I suppose any type of tax in Ireland is really self-assessment. So the way it works is you register with revenue for the tax, you fill out the return, you file the return, and what revenue will do is in most cases they'll accept it at face value. They do audit, but it tends to be a little bit in arrears, so that they'll audit maybe a year or 2 years ago. They tend to focus their audits, so very few audits, I suppose, are completely random at this stage. So they risk assess things. As I mentioned earlier, they've got a very sophisticated software system that's called REAP, and what that does is it collates the information and it identifies anomalies, and it points at areas they should go and look at. So I suppose the short answer is, in the first instance, no, it won't necessarily cause revenue to come knocking on your door, the fact that you register for payroll from the start of 2021. I suppose the advice would always be, though, if you think you've got an issue in 2020, you're better off dealing with it now. I suppose the first thing is you sleep better at night if you're not worrying about whether revenue are going to come looking at anything. But secondly, you could have a scenario where someone has, let's say, a tax liability in Ireland on income earned here in 2020, and they've paid tax in another jurisdiction for that same income in 2020 that they shouldn't have paid in the other jurisdiction. So I suppose worst case scenario is that you end up having to pay the tax in Ireland, but then you're not in a position to recoup the tax in the other jurisdiction. So you're better off dealing with it sooner rather than later, because in a lot of jurisdictions, there's a cutoff beyond which you can't go back to seek a repayment of tax. So for example, in Ireland, it's 4 years. You can't go back beyond 4 years to look for a refund from revenue if you've made an error that's in revenue's favor.
Okay, and okay. All right, there's one here. If you have share options vesting in Ireland in 2021, but they were given to me when I worked for the company in the US, is this taxable in Ireland?
It depends on a number of factors. So I suppose I know Share options have been mentioned there, but they could, I suppose, share awards more broadly can take different forms. So you can have share options, or you can have award of shares as well. So it depends on a number of factors. It depends on the nature of the award. But if you take a share option and it's vested in 2020 when you've been tax resident in Ireland, but if you were an employee of a US company originally and working in the US for a number of years beforehand, the chances are what you might be looking at is you might be looking at kind of a slight time apportionment of the value of the uplift, you know, what the share is worth when it vests versus what you have to pay. And you would time apportion that, so you may be taxable in Ireland on the portion that's relative to the period of time you've been working in Ireland compared to the overall period during which the shares were vesting, or the share options were vesting, I should say. Now, there's an interesting, I suppose, tale to that one that we've come across in the past, where you maybe have someone who's non-domiciled and they receive share options, but it's in a company that they work for, and the company is based abroad, let's say US multinational. It's well worth their while making sure they keep those shares abroad, that they don't bring the shares into an account in Ireland, that they hold them in the US or somewhere else, because as a non-dom, when you ultimately dispose of the shares, you might not be liable to CGT in Ireland, and also you may well be keeping the dividends outside of the Irish tax net as well.
Yeah, there's someone's asked here, are there any disadvantages of being non-domiciled in Ireland?
Not really. I suppose if you take a non-domiciled person in Ireland, one of the biggest advantages you have is that, albeit I suppose you're tax resident in Ireland, right? So that's the first thing. You are tax resident in Ireland, but then Ireland chooses not to tax a lot of your income. So the big advantage with that is you then get the benefit of Ireland's double tax agreements with all the other countries that it has these with. So to give you a very basic example, if you took someone who had a large portfolio of investments in the US, if you're not a resident in a treaty country with the US withholds 30% withholding tax on those dividends. If you're a tax resident in Ireland, that's reduced down to 15%. So that's, I suppose, a basic example. So there's no real disadvantage because you are a tax resident in Ireland, and you can, I mean, someone who's non-domiciled can put themselves in exactly the same situation as someone who's domiciled by just bringing all the income in. You bring it all into the tax net, but you have that option of keeping it outside of the Irish tax net. So it allows you to really structure your tax affairs very, very efficiently. And there can be circumstances then as well where it's worth making sure that you're not in a zero tax position in Ireland, that you do have a certain amount of income in Ireland. So if you take someone who moves here, let's say you take someone who moves here in their mid-50s, right? And they're going to be here for maybe 10, 15 years. If they bring a certain amount of income in, they can bring themselves within the scope of our national insurance, what's called PRSI, and that can get them qualification for the state pension when they turn 66. So it's well worth looking at all the angles when you're non-domiciled, because there can be pluses and minuses either way. There's no real disadvantage though to being non-domiciled that I can think of.
Okay, certainly not from a tax perspective anyway.
No.
Okay, and just one that from revenue's point of view, can a married couple have two different principal private residences? I mean, not related to this, but
yes, they can. They can. It doesn't have to be a common principal private residence. So it would just be back to being able to, I suppose, again, you go back to the fact that tax in Ireland is self-assessment. So if you take someone who disposes of a principal private residence, it's in the first instance, you decide what you think the correct treatment is and you file your tax return accordingly. If you got a challenge from revenue subsequently, it would just be a matter of showing that you did in fact reside in the residence. And I mean, that would be down to maybe showing that you're getting your post there, that electricity usage in the property, for example, is reasonable given that someone is supposed to be living there, all of these sorts of things, you know. I mean, there was a a famous case with a well-known Irish business person who had an argument with revenue about whether they were living in a property, and it came down to whether there was a kitchen installed or not.
Okay. We won't ask for any more detail on that.
The name, no.
Okay, I guess, and we just to remind people that it's all recorded, so everybody who signed up will get an email with the recording of it that they'll be able to listen to in their own time, just for people who are joining late. I guess to kind of wrap it up, a couple of questions about what the fines and penalties. So if you're in this position that you've been working in Ireland, but you're not tax resident here, and it's gone into mid-2021, like what, as best as you can, kind of map out what revenue's approach would be like, and what kind of fines and penalties are people looking at if they haven't dealt with this problem?
I suppose the first thing is there's time to deal with it, because if someone deals with it within or by kind of October 2021, they're in time to file an income tax return and make revenue aware of all the details and pay the tax, and you're on time, no interest, no penalties, no problem from revenue. Failing that, it's down to really whether you let revenue know about the problem, or whether revenue come knocking on your door. And then if revenue do come knocking on your door, it's down to whether you go, right, you're right, there is an issue, here's what I owe you, and here's the calculation, here's what I owe you. Again, depending on the factors in the case, the interest rate can kind of, or the penalty rate can run from 3% of the tax liability up to 100% of the tax liability. And the interest would run at about kind of 10% a year, very roughly. So
would revenue be just looking to get paid straight away, or would they say that, oh, actually I paid all this tax in France, but I was actually tax resident here, I didn't know? Can you wait till I get the money back from the French tax authorities? I
would generally, if you take a scenario where you're going to revenue and you say, look, there's a tax issue here, I want to regularize the situation, they look for you to pay at that point. And again, if revenue are, saying to you, we think you've got a tax issue and we think this is the liability, they'll be looking for you to pay it at that point as well. And I suppose one other thing just to be aware of is that, again, depending on the level of the tax involved, if you don't cooperate with revenue or make a disclosure to revenue, it is possible that your name could be published as a tax defaulter as well, and that's a public list that revenue put out once a quarter.
Okay, I guess what's the strange thing is that we probably look at that and go, normally they're business people or independent, kind of self-employed type people, but now this has gone into the world of PAYE. Because of COVID-19 travel restrictions, there's in all probability thousands of people in Ireland that are in this position.
Yeah, I mean, the last couple of years, you would, we spoke about the example of the contractors earlier working for multinationals. You would have seen a lot of those popping up in the revenue defaulters lists in the last couple of years. So it is something that can happen, I suppose, again, depending on the tax liability and depending on how you handle dealing with it, and that will all be dependent on that.
Okay, brilliant. That's everybody's questions answered. So we'll wrap it up there. Thank you for your time, David, and thanks for everybody for attending and for your questions. And there's just one question come right in at the end.
Mm-hmm.
This will be the last one. Do the tax treaties around double taxation not ensure that maximum liability for an income tax worker would be the difference between the two jurisdictions? In some cases, revenue might end up owing someone money, so it might look like filling out tax returns to see what the figures look like. It seems really heavy-handed that revenue can handle people in COVID situations as tax defaulters. Reasonable point.
Yeah, absolutely. I suppose it's an unusual situation in that I think people who are in this position are here accidentally. I don't think anyone set out to be non-compliant. The double tax agreements, the way they work is that it first of all, it assigns either primary taxing rights to one country or the other, or sole taxing rights to one country or the other. So generally, if you take someone who is earning income in a country and is tax resident here. I suppose the first thing is as well, for the double tax agreement to come into play, both countries have to want to be taxing that income. So if the scenario where someone has paid tax in the UK through payroll, it's almost like a withholding tax that your employer has withheld and paid over to HMRC on your behalf. You haven't filed a full self-assessment income tax return, so I suppose HMRC aren't necessarily saying this is the tax liability you have. If they were aware of all the circumstances, that, let's say, you know, again, the UK tax year, if we're taking UK as an example, runs up to kind of the start of April. So if you take someone who's been here from March to December 2020, as far as revenue or HMRC in the UK are going to be concerned, in all likelihood, for 2020-21, they're not going to be tax resident in the UK. They're going to be tax resident in Ireland, and they've earned their income in Ireland. So the revenue here are going to say that's taxable in Ireland. The fact that you've paid tax in the UK, you've not paid tax in accordance with the rules, so to speak. You should be getting that back. So we're assessing you for the full amount of tax. If it was a case where you paid tax legitimately in the UK, you'd get a credit for it in all likelihood if you're tax resident here. But in this kind of scenario we're talking about, the person should probably be going to HMRC or their employer and saying, I don't believe I should have been paying tax in the UK on this income for the period we're looking at, and, you know, finding out about how they recoup that.
The double taxation treaties really aren't designed to deal with this. It's not.
No, I suppose it's an unusual situation in that it's, if you took an example, say, I suppose to maybe contrast it with something, if you took an example of someone who is Irish tax resident, but they work in the UK, there are provisions there, you know, to deal with that, whereby the UK gets to tax it because the income is earned there. Ireland gets to tax it, but they allow a credit for the UK tax suffered. So, you know, that's how double tax agreements work. In this scenario, you're looking at someone who's been tax resident in Ireland for 2020 and has worked and earned in Ireland for 2020. So revenue here are going to view it that that's fully taxable in Ireland. There is no interaction with the double tax agreement because of that.
And I suppose I suppose it does seem heavy-handed, but the reality too is that those people have been living in Ireland. They've been using the resources of Ireland, using the roads, going to hospital. They've been, you know, Reverend, you can easily look at it like, you know, this is how we pay for all of this stuff, by taxing you. Yet you're paying tax in the UK. So
yeah,
besides that argument.
Yeah, I mean, yes, I suppose, and again, we were talking about revenue and how they tend to roll out projects earlier. If they identify a pattern where there's non-compliance, it's I suppose to some extent it's black and white to them. It's, well, this is what the legislation says, or you know, this is where you should be paying tax, and it's not really back to, you know, we know you didn't mean to be in this position. It's kind of, well, tax should have been paid here, and that's that. It tends to be black and white.
When you see things in the FT and CSO saying that 26,000 people have moved back since March, that's showing that there's a lot of awareness of what's happening.
Yeah. I think, and there's probably going to be a lot of that 26,000 people who are maybe in this scenario.
Yeah. All right. Well, on that, and I suppose the bottom line for everybody is don't sit in it, engage. Okay. So, well, thanks again for our time, and thanks for all the questions, good questions, especially at the end. So, just again, thanks a million for all your time and attending, and we're going to send out the recording to everybody, and there's a lot of information on our website as well on this, and lots of ways to get in contact with us. So thanks again, and see you again. Bye now.